Está con nosotros Elizabeth Geoghegan, Fixed Income Portfolio Manager de Mediolanum International Funds Limited. Elizabeth, good morning.
Good morning. Thank you for having me.
There are a lot of focus about Ucrania. What's the problem about Ukraine for Europe?
Yeah, it's definitely been a focus for markets, and we've seen a huge sell-off in Eastern European assets, and in particular Russian assets. And we expect that this will continue for the time being, that these assets will continue to be under pressure as long as we struggle to get clarity on the situation in Russia.
There has been a lot of volatility in the market since the start of the year. What has been the driver here?
Well, geopolitics aside, the biggest focus or cause of volatility in markets has been what we've seen in terms of there's been a lot of focus on the interest rate expectations from central banks. In particular, what we've seen from the ECB. So the ECB had a very hawkish tilt at the end of last year, and even despite this, they did say that interest rate hikes wouldn't happen in 2022. Now, this tone completely changed at the start of this month when markets started pricing in a lot more rate hikes from the ECB, and the ECB meeting at the start of this month would have been a great opportunity for Lagarde to push back on these pricing expectations and reiterate her patient stance. However, this is not what happened. Instead, we saw the ECB pointing to the upside risks to inflation, and also when asked about future interest rate hikes, Lagarde pointed to the economic projections that we will get in March of this year. This has been really what has caused the volatility that we've seen in European markets. Peripheral spreads have sold off, credit markets have come under pressure, and we've seen significant volatility in the euro also. However, we think that this should start to stabilise in the second half of this year when fundamentals start to come more into play.
Credit markets have been particularly stressed after the ECB. Why is this?
It's basically all down to QE. So QE has been a great beneficial support for credit markets for the last few years, mainly because the ECB has come in and been this supercharged buyer that has been relatively price insensitive and come in and supported prices even when markets were under stress. So the ECB have always said that they would not hike rates when they were undergoing QE. And so the prospect of earlier rate hikes has really meant that we've seen a bringing forward of the end of QE, which is what has caused the spike in volatility for credit markets, which is quite ironic considering that corporate balance sheets are a lot healthier now than they were pre-COVID, as corporates took advantage of low interest rates to lock in refinancing on their debt. However, despite this more healthy outlook for corporates, the removal of this supercharged buyer has really presented a big technical headwind for credit markets and corporate bond pricing in the near term. If we wanted to think of it in terms of ranges, we expect there to be continued volatility for the first half of this year, but as improving fundamentals and better carry opportunities come to the fore, we should see prices start to stabilise in the second half of this year.
How likely do you think a rate hike is in Europe in 2022?
So it's definitely becoming more likely, and markets are definitely pricing to reflect this. You see markets pricing for a few rate hikes from the ECB this year. And a big reason for this has been what we have seen from inflation in terms of the inflation picture. In the start of this month, we had the release of January CPI which came in at 5.1%, surpassing even the most optimistic of expectations. However, this, of course, included a 20% increase year on year in energy prices. And so we really want to look at core inflation, which also came in surpassing expectations. And this is crucial because this is what ECB members will look to look for evidence of sustained or durable inflation pressures. And when you couple this with the recent comments that we have seen from ECB economist Philip Lane, it really helps to paint a more constructive picture. So before COVID, the European market really struggled to get inflation above 1%. However, ECB economist Philip Lane has now come out and said that the expectation is that it will be very unlikely that we will return to this regime. So if you want to couple this with Lagarde's recent comments that inflation risks are tilted to the upside, it really looks as though the door to rate hikes, or indeed less accommodation, is certainly more open now than it was a few months ago. If we wanted to think about a likelihood for rate hikes this year, it's probably still too early to tell, but we should get more clarity next month when we have more economic projections from the ECB.
Your forecast, your outlook for the rest of the 2022?
Of course, yeah. I think it will continue to be a more challenging outlook for investors, especially for the first half of this year. Fixed income markets in particular have come under significant pressure year to date, and we don't expect this to change anytime soon. Also, currency markets, as we have central banks with differing paces of normalization, will see diverging interest rate differentials, and this should weigh on currency volatility. And looking to equity markets, we expect there to be continued volatility under the index level as investors continue to rotate in between sectors, and particularly the tug of war that we're seeing between growth and value sectors. So all in all, it will be quite a challenging year for investors, and we think that the continued volatility will mean that focusing on protecting portfolios from losses will be just as important as generating positive gains for investors this year.
Thank you very much, Elizabeth Geoghegan, Fixed Income Portfolio Manager de Mediolanum International Funds Limited. Elizabeth, good day, good business.
Good day.
Thank you
very much. Bye.